More than 90% of CFOs think we're going to get a recession in the next 12 months, and more than 50% think the market has not yet hit a bottom. I'm Scott Curry, and I'm going to explain why this is, so let's get into it. Stocks closed lower on Tuesday as the Dow and S&P snapped four-day win streaks as economic worries loom. One of the major indicators that bulls have used to explain why the economy is so strong has been the jobs data. And to be clear, this is pretty much the only part of the economy that has been strong. Well, that and consumer spending, even though consumers are spending on credit cards, they're not actually using money they actually have. But when it comes to the actual jobs market, one of the biggest things was that there were over 10 million more jobs than there were available workers. In fact, there were 2 jobs for every 1 available worker. But now that's no longer the case. Job openings tumbled below 10 million in February for the first time in nearly 2 years. Job openings for January were also revised downwards. Prior to February data, job openings had been outnumbering available workers by nearly 2 to 1, but the latest figures bring that ratio down to less than 1.7 to 1. Now that's a pretty significant 1-month drop, and it leads a lot of people to believe that the job market could end up falling really fast, and unemployment rate could end up rising really fast as well. Treasury yields fell following the release as data could help dissuade the Fed from further rate hikes, but stocks also moved lower. The belief here is that as the labor market data comes in weaker, that might cause the Fed to pause and possibly even pivot later on down the road because they want to get inflation down, but they don't want to crash the job market. Remember, the Federal Reserve has a dual mandate. They have to keep the labor market strong, but they also have to get inflation down. And these kind of go against one another. In order to get inflation down, you have to bring the labor market down. And if you want the labor market to be strong, then you have to allow inflation to go up. And right now, the Fed has made it very clear that they are focused on inflation as their #1 priority. Now, the JOLTS data that came out on Tuesday comes 3 days ahead of the fresh non-farm payroll numbers for March. The Friday Labor Department count is expected to show a gain in jobs of 238,000, with the unemployment rate holding steady at 3.6%. And even though the jobs data on Friday is the bigger market move compared to the JOLTS data that came out on Tuesday, still, the Federal Reserve tends to look at the JOLTS numbers more so than they look at the official Bureau of Labor numbers that come out on Friday. Also to be aware of is that the ADP private payroll numbers come out on Wednesday as well. Now, the main reason why job openings are coming down so fast is because companies are laying off employees and hiring freezing. GM said they're going to take buyouts from 5,000 salaried employees. It's going to cost them $1 billion in the short term, but will help lower their costs in the long term. In addition to GM's layoff of 5,000 employees, Walmart is cutting 2,000 workers in their e-commerce division. And the layoffs have become so fast and so massive that Forbes now has a 2023 layoff tracker. In addition to the layoffs Walmart did today, they also laid off 200 workers previously. Then yesterday, McDonald's cut hundreds of employees as part of their restructuring plan. Also yesterday, Highland Software cut 1,000 employees. On March 30th, Virgin Orbit went out of business and cut all of their employees. Roku is letting go of 6% of their staff. That was announced a few days ago on March 30th. A day before that, Electronics Arts announced that they were laying off 6% of their staff. And on the same day that happened, Warner Music announced they were laying off 270 jobs. A day before that, Lucid Group announced they were cutting 18% of their employees. A day before that, Disney announced that they were cutting 7,000 jobs. And a few days prior, Bed Bath & Beyond announced they were laying off 1,300 employees. 2 days prior to that, Indeed announced that they were laying off 2,200 employees. And the same day that happened, Glassdoor announced they were laying off 15% of their workforce. And you can go through the layoff tracker on Forbes.com. It just continues on and on and on. In fact, there have been more tech layoffs in 2023 than there were in all of 2022. And we're only 3 months into the year. Now, the most telling is the fact that Indeed and Glassdoor did layoffs. And Indeed and Glassdoor, they are the companies that help people find jobs. And the labor market has dried up so much that Indeed and Glassdoor are now laying off employees. So this points to some major problems in the economy on the horizon. And it's why a lot of people think that a recession will happen this year if we're not already in one. And while a lot of retail investors think this is the start of a new bull market, CFOs aren't buying it. A lot of bulls look at the historical data and they look at the fact that after a major drop in the market, the following year is usually extremely bullish. The average gain is over 30%. And you take that a step further when we have the massive rise that we had in the first 3 months of the year, with the NASDAQ up 17%. On average, it's one of the best years ever for the stock market. So if you look at the historicals, we should be hitting new all-time highs by the end of the year. And this could be one of the best years ever for the stock market. But there have been exceptions to that in the past. Most recently, in 2002, the stock market continued to sell off and actually sold off by 50% in the second year. There were also numerous times during the high inflationary period in the 1970s and early 1980s where we had multiple back-to-back years of the stock market going down. The fact of the matter is the stock market isn't going to bottom out until the Fed starts cutting rates. And whether or not you think the Fed is going to cut rates this year, or if they're going to stick to what they said they will do and keep rates elevated for longer than the market is expecting, well, depending upon which part of that you believe in, that's going to depend upon your outlook. So if you believe that the Fed is lying and you want to fight the Fed and you think they're going to cut rates, then yeah, the market could go up. But if you think the Fed is telling the truth and they are going to hold rates here longer, even if it leads us into a recession in order to get inflation down, well, then you got to believe the market is going to new lows. Traders like what they see in the market history, with the S&P posting huge gains in the years after the first quarter starts that are this strong as the one in 2023 has been. But under the hood, the recent big gains in the broader market index have really only come from a few big tech stocks, including stocks like Apple, Microsoft, and Nvidia, which have posted quarterly gains of over 20% this year. And you got to understand, these dominate the market-weighted approach of the S&P 500 and especially the NASDAQ. So if you look at indexes like the S&P and the NASDAQ, it looks like we had an amazing start to the year, which could lead to one of the best years ever in the stock market. But once you start digging a little bit deeper, you start to realize that those gains were only in the mega cap tech stocks, and the rest of the market, by and large, missed out on the rises. So this may not follow history like you think it will, because the entire market isn't rising. It's only a few mega cap tech stocks that really rose, kind of skewing the numbers on the S&P and the NASDAQ. The fact is, when it comes to chief financial officers who usually have a really good idea of where the economy is, fewer CFOs this quarter rate the chances of a new high in the Dow as being more likely than a fall back to new 52-week lows. In fact, less than 15% of CFOs think we are going to get a new high in the Dow, and 57% of CFOs think we're going to go back to new 52-week lows. But with all of the volatility and uncertainty, It should be noted that nearly 1/3 of CFOs say they don't have conviction about the next trend in stocks. But despite the uncertainty around what the stock market will do, the vast majority of CFOs, more than 80% of them, still expect a recession in the next 12 months. 56% of CFOs expect a recession to happen this year in 2023, with the remainder expecting a recession to start in the first half of 2024. The fact is, inflation is not going to get back to anywhere near the Fed target of 2% anytime soon. And more than half of CFOs predict that inflation will not return to 2% until 2025, with some thinking it's going to be even longer than that. And with the Fed committed to fighting inflation, the odds of the Fed cutting interest rates this year are extremely low. In fact, less than 10% of CFOs expect the yield on the 10-year Treasury to be lower than it is today by the end of the year, meaning less than 10% of CFOs expect the Fed to cut rates by the end of the year. So if you're wondering why influencers such as myself aren't super bullish on stocks right now, it's because we're not buying into hope and hype. We look at the facts and the fundamentals, and we realize that things are really bad, and we probably have not yet hit a bottom in the stock market. And the fact is, the market is getting it wrong by expecting the Fed to cut rates 4 times this year. Fact of the matter is, the Fed is more likely to increase rates. And in other signs that the economy is suffering, Jamie Dimon says the banking crisis is not over and it will cause repercussions for years to come. His statement sent banking stocks tumbling on Tuesday. Jamie Dimon said the stress on the financial sector caused by 2 bank failures in the United States last month is still a threat. The current crisis is not over yet, and even when it is behind us, hopefully in the next few months, there will be repercussions for it for years to come. Most importantly, though, Jamie Dimon stressed that the recent events are nothing like what occurred during the 2008 global financial crisis. Essentially, what Jamie Dimon said in his letter was that while the bank issues need to get resolved by the government, so long as the Fed, the Treasury, and Congress all step in and hold up the banks, provide some backstops for deposits, things like that, so long as they all work together to stop any more bank runs, we are going to get past this, and we're not going to see anything like the 2008 financial crisis. So there is hope, but we definitely have a lot of problems in the economy, and the jobs data that came out on Tuesday shows that things are about to get a whole lot worse. Now, if you want to know what we're doing while the economy approaches and enters a recession and how we make money as the market goes down, I want to encourage you that just because the market sells off doesn't mean you have to lose money. Last year, the market was down more than 20%, and my portfolio is up. I made money last year. You can make money this year too, even if the market crashes again. And I want to show you how to do that. I have an entire coaching program where I teach you how to trade options. And I'm not just talking about single leg options. I'm talking about the far more complicated multi-leg options, as well as teaching you how to do technical analysis so that you can chart these and figure out your best time to buy and sell so that you can make the most amount of money possible. If you want to learn how to trade options with us, I'm currently offering 20% off of the coaching program. That is good for any version that you sign up for. The annual rate, the lifetime, a mastermind, whatever you want, you get 20% off right now if you sign up. So if you want to take advantage of that Easter sale, get the 20% off. You have to do so in the next few days before the sale ends. All you have to do is schedule a call with my onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com, and he will get you onboarded and into the program. If you got a lot out of this video, be a good friend and share this video on your social media pages and Reddit and elsewhere so that others will know what to expect in the market ahead as well. And don't forget to hit the like button and subscribe. I hope you guys have a lot of success trading. If you missed my video yesterday where I explained why a recession has already started, make sure you watch the last video that I uploaded here.